Hello, everyone, and welcome to the Outspoken Market. Leandro Guerra is speaking. And in today's lesson, I want to call your attention for something. People tend to think that what breaks the market is trend shifts. So you are coming, like the example here from the S&P 500, from a downtrend, and then you started an uptrend, and then it means the market broke over here and then it started to do something else. This is a misconception. What really breaks the market is the volatility regime shift. As I like to say, volatility is the soul of the market. So one thing that you must start focusing right now, it's on volatility. Now, I bring this example from the S&P 500 because it's very clear about some movements that we had in the recent past and not so recent like 2022. That year in particular, we had an entire year of a downtrend. Once that downtrend is stopped in the beginning of 23, we had a small uptrend followed by a small downtrend and then a very long bull run after that. You, as a trader, as an investor, whenever we have these volatility regime shifts, that as you can see, they can be modeled, but exactly the way that we do that will be for another lesson. I want you to understand the foundations, the structure of the market, that is the volatility, in today's lesson. You have the obligation, yes, obligation of adapting your strategy, meaning recalibrating it or even developing a new one whenever you have such shifts. This is one point. And why? Because not all uptrends or downtrends, they are the same. Actually, they will never be. For some, this may sound a little bit obvious, but it's not so obvious because eventually you have a very good strategy, you have a very good model, and you have reached a level of generalization that you can benefit from these different trends without doing much more to changing the model. However, if you have done so, your model likely will have performed way better than it might already have been performing so far. One point that you also must pay attention is start thinking in translating these volatility regime shifts in a kind of another model, an indicator that would point out to you which kind of strategy to run. Let me show you something. And this is fully available for you to check free at om-qs.com. You come here in models, OMSND, and then when you put your preferred asset over here, you will get the volatility impulse from the outspoken market. This is a translation, or better saying, a reading of the market shifts in volatility in a way that it's quite easy to be understood. Imagine that you have here the zero line, that it's the base foundation of the market energy, the volatility. If you get far, it doesn't matter if it's in the positive zone or negative zone from that zero line, it means that the movement you were heading, it's about to change, or it has a higher probability of changing. Let's pick up a very clear example. And the S&P 500 is good because it has very clear movements once in a while. So from November 24, we started the acceleration in the impulse. So the energy was increasing. And then the uptrend we were having since September 24, it started to get choppy. So we started to be in a lateral mode. Not only you can clearly see around the end of 24 that the ups and downs, they started to get bigger. So you were still going sideways, but with higher energy. And then the market broke with the downtrend from 2025. When this downtrend was developing, the volatility impulse was getting lower. It had a break here in the middle around zero, suggesting that the market had low energy, and then it started accelerating again. Here was already a prelude that this downtrend would not last so long. And come on, people, just few months. This is not a long time. Long time, we speak about years. So you are the sons of the bull market. You have never seen actually what a very large downtrend or a very long bear market really is. You will see one day, but it's not the time right now. So the point is, when this downtrend was developing, the energy naturally of the market was going down, suggesting when we were far from the zero that this was likely to come to an end around this area. And this is what really has happened. So it came over here. We got yet some very volatile days, but then the downtrend stopped. We went to the beginning of the uptrend that we have so far in this calendar year. Notice that as the energy was going up again, trend was developing, we got to the peak, we got choppy again, just like over here. Then we got another down level in the volatility impulse. And then one may say that, look, Leandro, but here we got a downtrend. Here we got the impulse coming down, but the market was still up. Remember, this is not about predicting the direction. It's about predicting the regime shifts that lower levels, or actually those lower levels of volatility impulse are suggesting that the probability of this movement moving forward is getting lower. So we are likely to see at least a break in that very large uptrend. So we know that the markets not necessarily makes V movements. They usually, before large movements, they get a little bit sideways like we had here, or even if it's just shorter period sideways, what we got here and then we got here. We have at the moment a higher probability of this happening at this point in time. It could be end of September, could be beginning of October. The point is, you must adapt yourself, adapt your strategies when you notice these regime shifts. If we add the supply and demand levels, you will see that once again we are touching the first supply level, and as history suggests, and this indicator has a very good accuracy, we are about actually to really have a change in the price. Whether this is going to be again yet up, it will not come before a break sideways, or even a reversion could be expected as we had in previous years or months in the S&P 500. Remember, this is a free tool. My objective here is to teach you to have this different type of reading, not related to the common sense, because you can quite easily pick up one of your favorite large language models and develop something that would identify volatility regimes. Could be a hidden Markov model, as we have seen in other lessons in this channel. It could be something else. It doesn't matter. It's not so difficult to do. What is really difficult is that it's not something that you see every day. It's okay, what I'm going to do with this thing. How do I keep that stable? How do I keep the precision over time? How I do the right reading about what I'm seeing as an outcome of the model. And this is what I taught you today in this lesson. Because look, one, volatility is the soul of the market. It's the foundation, the main structure. When we have the shift, not in the trends, but in the volatility regimes, it doesn't matter if we are going up and down, it's where the market it's gonna change its structure, and you have to change also your strategy, recalibrating or developing a new one. And then you can think in translating this kind of reading in a type of indicator like the outspoken market volatility impulse in the way that we have seen over here. If you like this video, click the thumbs up, leave your questions, your comments, any suggestion for next ones, and share the channel with your friends. See you next time. Take care. Bye bye.